Hey, how's it going, guys? Welcome back to another episode of Weekly Market Update. In this video, I will do a quick update on the US equity market, the bond market, the dollar, and of course the June jobs report that just released on Thursday. Also, I will share with you guys an extremely important bubble indicator to watch in the equity market. So please make sure you watch the video to the end and don't miss out anything. I promise you I will make it quick and don't waste your time. Alright, let's get started. We just had another pretty strong week before the long weekend. S&P 500 was up 4% in 4 trading days. If we look at the S&P weekly chart, we can see that it tried to break out from this 78 Fibonacci retracement level, but it failed again. S&P has tested this level 4 times. Basically, it took the entire month of June trying to break this strong resistance level and go higher, but all of these 4 breakout attempts failed. On the daily chart, we also see the S&P 500 has been rejected by this resistance level 5 times. Especially on Thursday, the S&P 500 had a very strong gap up open, seems like a strong breakout. But the momentum faded away quickly and the market closed below this resistance level. From the technical perspective, the more failed attempts in a short period of time, the more significant this resistance level becomes. So in the next 1 or 2 weeks after this long weekend, it will be very interesting to see if S&P 500 will break out from this level or rejected by this resistance one more time and head lower. Last week, in the weekly market update video, I divided the short-term market structure into 3 different zones. From 3100 to 2900, it's the do-nothing zone. So basically, it's what I believe the most likely scenario that in June and July, the market will be consolidating in this range before the next big move. From 2900 to 2800, the 61 to 50% Fibonacci retracement levels is the support zone and is also the potential buy zone. If S&P 500 has a short-term correction that breaks into this range, then it will be a great opportunity to look for long setups in the stock market. And below 2800, it will be the danger zone. And we need to reassess the entire market structure again if the S&P 500 drops below 2800. So basically, this is the short-term technical framework that I used in the previous month of June, and I will be continue using it in July as well. If you want to know more about this short-term framework, I will put the video link in the description below so you can take a look. The bond market has been pretty quiet. 2-year yield, 10-year yield, and 30-year yield are all still staying in the bear market territory. And especially the 2-year yield is trending down again. These are definitely not good signs for the stock market. On the other hand, the dollar shows some weakness. It was rejected by this key resistance level again this week. But what I'm really worried is that the dollar has been making all these short-term higher lows and formed this ascending triangle pattern. In technical analysis, ascending triangle pattern is considered as a bullish pattern, and it tells us the dollar has a higher probability to break out from this triangle pattern and go higher. If the dollar goes higher and the bond market still stays in the bear market range, then that would definitely add quite a lot of bearish pressure over the stock market. Alright, on the fundamental level, the biggest news this week was definitely the June jobs report on Thursday. In June, we added 4.8 million jobs, beating the estimate of 3 million. Unemployment rate also dropped to 11% from 14% in May. A lot of people believe this is a very bullish sign for the stock market, but I'm not fully convinced that this June jobs report alone is bullish enough to push the stock market higher, and here's why. On the upside, the jobs report did show us the economic recovery is faster than we expected, and the government fiscal support has been definitely working so far. But on the downside, this report gives us a strong signal that the rehiring number in the US labor market is slowing down, especially with the current COVID-19 second wave outbreak, which seemed to be even worse than the first wave itself. The rehiring process in the labor market is expected to be severely disrupted in July and August. And this rehiring estimate is still under the assumption that we will not have another major lockdown. Although I don't believe US will have another major lockdown, I do believe the Congress will have no choice but to issue a new round of stimulus program to help the rehiring process and the labor market, and as well as the entire economy. Especially we're in the middle of the election year, the current administration will do whatever they can to push the new stimulus bill passed by the Congress as soon as possible. This is the estimated amount of next round of fiscal stimulus. So basically, we're looking at almost another $1 trillion to be injected into the economy. Then ultimately, what truly moved the market this week was actually not too much about the June jobs report, but it is more about the expectation on the next round of the government fiscal stimulus. And that is the key. That is what truly moved the market. So this is how I summarize the June jobs report. The numbers are good enough to show the investors our economy is indeed recovering, but also the future guidance is bad enough to show the government we need more stimulus money. So in July and August, let's see if we can get the next round of fiscal stimulus bill passed by the Congress and as well as how much money they approve to print. Alright, back to the chart. We all know this market is extremely addicted to the government stimulus helicopter money. Where the market will go next is gonna heavily depend on if the bill will pass. So what I would say here, in the next couple weeks, the biggest drive for the next potential breakout from this strong resistance level is gonna be driven by the next round of fiscal stimulus. Before the investors can draw any clear conviction about the next round of government support, the market will continue this range consolidation, or even have a short-term correction to the downside to push the Congress to pass the bill as soon as possible and also the size of the stimulus as large as possible. A lot of investors have been debating whether we're in a massive stock market bubble or not, and most of them use the same old-school S&P PE ratio to determine the bubble territory. If you don't know how the S&P PE ratio works, let me explain it real quick. PE stands for price to earning. When you use the S&P 500 index price divided by the S&P 500 company's average earnings, you get the PE ratio of S&P 500. This is probably one of the most widely used valuation metrics for all the investors, even for institutional investors. The historical average PE ratio for S&P 500 is around 14. So anywhere around 13 to 15, that will be considered fair value. Anywhere between 15 to 20, it is considered overvalue. And if the S&P PE ratio breaks out to above 20, then that will be considered a market bubble. Right now, our PE ratio for S&P 500 is at 22, so it's at the lower end of the bubble territory. I do use PE ratio pretty often in my own investing analysis, but right now, in 2020, in our current market condition, I have one major concern about using the S&P PE ratio, which is the current S&P 500 is extremely over-concentrated on the top 5 to 6 companies, and the PE ratio of S&P has lost most of the bubble tracking ability. If you have followed this channel for the past 2 months, you definitely heard me talk about it quite a few times. When the top 6 companies almost occupy 50% of the entire index, S&P 500 is no longer a good representation of the entire US stock market. So what should we use now? Actually, there are some other bubble indicators that are more suitable for this year's unique market environment. One of my favorite ways is to use Nasdaq to Russell ratio as the bubble indicator. So what is Nasdaq to Russell ratio? Basically, it's an index that uses Nasdaq index value divided by the Russell 2000 index value. Why does it matter? Because this ratio shows how much the US stock market is over-concentrated on the large cap tech companies. We all know the Nasdaq is the index that is dominated by the large cap tech companies, where the Russell 2000 is the small cap company index. When this concentration on the large tech companies keeps going up, this is a sign showing us that there is too much money in the market chasing too few companies. And that is the textbook definition of a bubble. For example, back in the 2008, it was too much money flooding into the housing market due to the cheap mortgages, and that created a huge housing bubble, which eventually almost collapsed the entire banking system. This time, in the stock market, it's too much money chasing too few large cap tech companies. Right now, the largest 6 companies in the US have already occupied more than 50% of the entire S&P index. That is pretty insane and mind-blowing. In our history, it only happened once when there's too much money chasing a few tech companies, and that was back in the 2000, the dot-com bubble. That is exactly why we're seeing this Nasdaq to Russell ratio had this huge parabolic move back in the 2000. That shows how crazy the investors were pumping money into the stock market and chasing the tech stocks. This year, especially with all those new retail traders jumping into the stock market with their stimulus checks and chasing those top names, it feels like 2000 all over again. From January this year, the Nasdaq to Russell ratio seems to be ready for another crazy parabolic move, and that is an extremely dangerous bubble signal. We're already very close to the 2000 dot-com bubble territory. It'll be very interesting to see how this Nasdaq to Russell ratio is going to play out for the rest of the year, because it can give us another extremely important perspective to navigate the US equity market other than just S&P 500. Alright, that will be the end of this video. If you're new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market, and also what are the trade ideas or investment opportunities that you should pay attention to in the market. If you are interested in the world of finance and business and find my videos have been valuable to you, please consider subscribing. Thanks so much for watching, guys, and I'll see you guys soon.